concept assembly line, where ideas get to work. Every federal budgeting cycle, the ritual repeats itself. Forecasts darken, television anchors lower their voices, and solemn officials take to podiums to warn that America is hurtling towards a fiscal cliff. The metaphor needs no elaboration. It conjures an image of sudden collapse, a free fall into economic ruin unless drastic action is taken, austerity measures, spending cuts, and fiscal restraint. Yet each time the cliff draws near, the collapse fails to materialize. The economy moves forward. Life continues, largely untouched by the doom so confidently predicted. The fiscal cliff is not a precipice at all. It is a mirage, a shadow created by your own misunderstandings of how money, debt, and modern economies actually function. Chasing it, acting as if it were real, does not save us from ruin. It risks creating the very stagnation we seek to avoid. To see this clearly, we must return to questions that are rarely asked in serious political conversation. Where does money come from? How did it come to work the way it does? And why do so many of our instincts about debt and deficits cling to a world that no longer exists? In the early decades of the American Republic, money was a fractured and unstable phenomenon. There was no singular national currency. Instead, thousands of private banks across the country issued their own notes, each promising, not always reliably, redemption in gold and silver. A traveler moving from Boston to Chicago might find that his banknotes, perfectly acceptable at home, were discounted steeply or even refused in distant cities. The value of money was fragile, a matter of proximity, rumor, and trust. This chaotic period, known as the wildcat banking era, sowed deep instability. Banks failed with unsettling regularity. Financial panics rippled through the economy. Money itself seemed unreliable, a shifting foundation upon which it was dangerous to build anything lasting. The Civil War forced the first serious transformation. Faced with the urgent need to finance its armies and maintain national cohesion, Abraham Lincoln's administration introduced the greenbacks, the first federally issued paper money not backed by gold, but sustained solely by the government's decree. It was a consequential move, a fiat currency created by law rather than a promise of metal. After the war, America tried to restore faith in a more tangible system. The National Banking Act sought to regulate currency issues, binding it to government bonds. The Gold Standard Act of 1900 formalized the idea that every US dollar was redeemable for a specific weight of gold. For a time, this arrangement provided a sense of order and permanence. Gold offered psychological comfort. It reassured citizens and investors that money was real, that its value was anchored to a physical object immune to political whims. Yet, the very rigidity that gave gold its appeal also imposed hidden costs. A currency tied to a finite commodity could not easily expand to meet the growing needs of a dynamic economy. Population growth, industrialization, technological change all demanded increasing liquidity. But under gold, the supply of money could only grow as fast as miners could extract new metal from the earth. Economic expansion was throttled by geological discovery, not by human ambition or innovation. Every surge of growth risks being choked by deflationary pressures. Every downturn risks becoming a downward spiral as tight money forced wages lower and demand to collapse. Stability came at the price of flexibility. The gold standard could impose discipline, but it also entrenched suffering. These contradictions became visible during the great economic crises of the late 19th and early 20th centuries. The Panic of 1893, the Great Depression of the 1930s, both revealed how a gold-backed currency could transform a financial downturn into a human catastrophe. Unable to create money freely to stabilize the economy, governments were forced to cut spending, raise taxes, and tighten credit precisely when relief was most needed. Gold was indifferent to unemployment, to hunger, to social unrest. Franklin Roosevelt's administration broke this deadlock in 1933, abandoning domestic gold redemption and devaluing the dollar against gold to reflate the economy. Yet internationally, gold continued to haunt the system. After World War II, the Bretton Woods arrangement fixed global exchange rates to the dollar, and the dollar itself was convertible into gold for foreign governments. For a time, this provided a stable anchor for global trade, but it carried within it the seeds of its own demise. As the United States took on growing international obligations, financing reconstruction in Europe, sustaining military commitments across the globe, underwriting an expanding consumer economy at home, the artificial constraint of gold increasingly strained the system. The American economy needed more dollars in circulation than gold could credibly back. By the 1960s, the cracks were impossible to ignore. Foreign central banks accumulated more dollars than the US Treasury could possibly redeem in gold. Speculation mounted. Confidence wavered. The elegant architecture of Bretton Woods, constructed to bring order out of the chaos of war, began to tremble. In 1971, President Nixon made the fateful decision to sever the final link. In an address to the nation, he announced the suspension of the dollar's convertibility into gold, what became known as the Nixon shock. Overnight, the global monetary system shifted from one of metallic constraints to one of sovereign fiat. Money would no longer be a claim on buried treasure. It would be a claim on the future productive capacity of human societies, on labor, ingenuity, and cooperation. Fiat currency, though often maligned, allowed something gold could never permit. It gave governments the ability to respond to crises without waiting for miners to deliver salvation. It allowed investment in infrastructure, education, and public health without artificial ceilings. It aligned the supply of money not with the luck of geology, but with the needs and capabilities of a growing, evolving society. Yet, even as these realities changed, the mental models lagged behind. We continued, and in many quarters still continue, to speak of money as if it were a scarce commodity, a finite object. We imagine sovereign governments as households, bound by the same rules of budget and balance. We fear deficits as if they were real acts of irresponsibility rather than tools of economic stewardship. We no longer live in the world of vaults and bullion. We live in a world where money is a tool of policy, an instrument to be used wisely, managed prudently, but recognized for what it is, a creation of human law, responsive to human needs. It is essential to seeing why the fiscal cliff is a mirage, and why the true danger lies not in the money we create, but in the futures we fail to build when fear paralyzes action. In today's economy, money enters circulation through two distinct but deeply interconnected engines: fiscal spending by the government and monetary lending by private banks. When the federal government spends, whether paying a soldier, building a highway, or funding a research grant, it creates new dollars by crediting the bank accounts of its recipients. From an accounting perspective, the government records a liability, a promise to honor the currency it has created. The private sector, in turn, gains an asset, new financial wealth with no corresponding private debt attached to it. This process is fundamentally asymmetric. It creates new net financial wealth for the private sector. The dollars generated through government spending are not borrowed from some pre-existing stock. They are new claims on goods and services made real by the government's power to tax, to regulate, and ultimately to ensure the currency retains its value through law and governance. They are effectively tax credits that we trade for goods and services. Private banks also create money, but in a very different way. When a bank issues a mortgage or a business loan, it doesn't lend out existing deposits. It creates a new deposit, a new balance in the borrower's account paired with an obligation, the borrower's debt. Every dollar lent into existence through the banking system is mirrored by a dollar of private liability. Unlike government spending, which increases net financial assets, bank lending reshuffles liquidity. It facilitates commerce and investment, but it does not inherently expand the private sector's balance sheet without also weighing it down with obligations. The distinction matters. Fiscal spending, when properly deployed, can strengthen the foundations of the economy, building infrastructure, funding basic research, stabilizing incomes during downturns. Private lending, while essential to dynamic growth, can amplify risk and fragility if left unchecked. When we confuse these two engines, treating all new money creation as inherently inflationary or reckless, we blind ourselves to the real levers of economic resilience. Since most of us are not direct contractors to the government, bank loans are the most visible form of money creation in our day-to-day lives. This distorts our collective view on money creation as a whole. Fiscal spending expands the limitations of our collective economy, allowing GDP room to grow. Private lending allows individuals to expand their individual economic capacity, but only temporarily. Private lending carries debt. Fiscal spending doesn't. If government spending creates money, a natural question arises. Why does the government bother issuing Treasury bonds? The answer lies not in financing spending, but in managing the plumbing of the financial system, a network of balances and transactions that undergirds every modern economy and which must be carefully stabilized to prevent either inflationary spirals or credit crunches. Every commercial bank maintains an account at the Federal Reserve, a reserve account that functions much like a high-powered checking account. When Bank A owes money to Bank B, say to settle a customer's wire transfer, it instructs the Fed to move reserves from its account to Bank B's account. These interbank transactions happen continuously, invisibly, every day, forming the bloodstream of the financial system. Reserves, unlike deposits in the broader economy, are not spent on goods and services. They circulate only among banks and the central bank, allowing payments to clear safely and efficiently. When the government spends by, for example, paying a defense contractor, it credits a private bank account. Simultaneously, the Treasury's account at the Fed decreases, and the reserve account of the recipient's bank increases. In other words, government spending injects fresh reserves into the banking system. In times of deficit spending, when the government consistently spends more than it taxes, the supply of reserves grows. If left unchecked, this growing pool of reserves would drive down the interest rate at which banks lend reserves to each other overnight, the so-called Fed funds rate. In a world flooded with reserves, no bank would need to borrow reserves at any cost above zero, because reserves would be abundant and effectively free. This would make it impossible for the Federal Reserve to steer monetary policy through interest rate adjustments, one of its primary tools for influencing credit investment and inflation throughout the economy. To maintain control, the Fed intervenes by conducting open market operations. It sells Treasury securities to the banks, draining reserves from their accounts in exchange for bonds. This absorbs excess liquidity and supports a positive short-term interest rate. Conversely, when the Fed wants to ease financial conditions to lower rates and stimulate the economy, it buys Treasury securities, injecting reserves back into the system and encouraging lending. In this sense, Treasury bonds are not sold because the government needs to borrow the dollars it has already created through spending. Rather, they are issued and traded as tools of monetary engineering, instruments that allow the central bank to calibrate the flow of reserves, maintain stability in short-term funding markets, and anchor broader credit conditions throughout the economy. At the heart of America's fiscal anxieties lies the national debt, a figure so large that it seems almost mythic. Yet behind the abstraction is a simple accounting reality. Every dollar of federal debt corresponds to a dollar of private sector financial assets. The bonds held in pension funds, insurance portfolios, and investment accounts are the mirror image of the liabilities recorded on the government's books. Were the national debt to disappear overnight, so too would much of the private wealth it supports. The debt is not a burden imposed on the economy like a private loan. It is the shadow cast by national prosperity, the record of money spent into existence to fuel growth, stability, and opportunity. To fear the debt without understanding this relationship is to fear our own reflection, to mistake wealth for danger and prosperity for peril. The true danger we face is not the fiscal cliff, but the panic it inspires. It is the reflexive austerity imposed when deficits rise, the abandonment of public investment precisely when it is needed most, and the paralysis that stems from outdated metaphors about money and debt. In a fiat economy, the real constraints on public spending are not financial abstractions, but physical realities, labor, resources, technology, and ecological limits. Spending beyond these capacities invites inflation and instability. But spending wisely within them builds the foundation of a flourishing society. Fiscal responsibility is not the art of saying no to deficits in all circumstances. It is the art of investing wisely, daring to build and managing the economy with an eye towards abundance rather than fear. The shadow we fear is our own wealth. Recognizing that truth is the first step not towards retreat, but towards the deliberate, confident construction of the future we wish to inhabit. Did you like this video? Like, subscribe, and share. Help get the word out.